So I want to introduce the First Financial team. We have Bob Grawl and Drew Haggai joining us today from the First Financial Pharmacy Lending team, and they will be going over financing your pharmacy future.
Okay, thanks, Kelly. I just want to mention my RPH on that title slide. It should say retired after it. I just noticed that. I did retire my license. I'm not practicing anymore. I don't think you'd want me to at this point, actually. Drew?
All right, my name is Drew Haggai, and I'm a loan officer here at First Financial Bank, and we're going to walk through sort of what we do on a daily basis and how we help pharmacists realize their pharmacy ownership dreams. I want to start out just by asking a few questions for you to just ponder internally about what would hold you back from pharmacy ownership if you're not already a pharmacy owner, or if you're looking to buy a second store, start a second store, third store, fourth store, wherever you may be on your journey. There are some things that can be intimidating along the way. For instance, determining what a pharmacy is actually worth in today's market with margin compression, PBM pressure, DIR fees, multiples of EBITDA. How do you value what an independent pharmacy is actually worth so you know that you're paying a fair price and getting a good deal? How do you analyze financial trends? What are the down payment requirements? How long does this process take? If you're talking timelines with potential sellers, or if you're starting one, how long should you plan for before you get customers in your door? And then what advisors should you use? These are all things that we hear often from pharmacy owners and potential owners. And so we're going to talk through some of those things today and hopefully address those concerns, talk through with you, and then also offer advice as you head down the path to ownership. So today we're going to talk about whether or not what you need to do on your end if you're going to buy or start a pharmacy, how to effectively and accurately perform a valuation, and then go over some do's and don'ts of an acquisition, pitfalls that we've seen over the years. We've been doing pharmacy lending for over 10 years now. So we've seen, I guess, a lot of different things and can offer some perspective in what you should and shouldn't do when buying a pharmacy. So feel free to use the chat feature if you have questions that we don't cover, and then we'll have time for questions at the end. But that's sort of what we're going to talk about today.
Yeah, and I didn't really properly introduce myself. I'm semi-retired, so I'm serving as a consultant for the bank right now, and do some consulting work, some analysis, and then some of these webinars, and also can help you all if you ever need any help. So don't hesitate to reach out to us. Drew mentioned we've done a lot of these. I've probably worked with over 100 businesses over the years in a previous life. I developed the RX ownership program for McKesson and ran that for about 7 or 8 years. So we've seen a lot between us. Drew, you want to tell us why we're qualified?
Yeah, so get to know us a little bit better about who we are and what we do and how we help pharmacists. So we are a community bank, but we're also a national lender, all 50 states, and we're a national preferred SBA lender. So I would say 9 out of 10 pharmacy deals, if there's financing involved, is probably going to go through the SBA, the Small Business Administration. It's a great fit for community pharmacies for a lot of different reasons, but it's a good option. So we have a level of expertise not only in pharmacy but also in SBA. Between our colleagues, myself, Bob, other members on our team, we have over 80 years of combined pharmacy experience. So we feel we're uniquely positioned and can help you guide your way through pharmacy ownership. Bob, as he said, is I guess, former pharmacist and owned stores for a number of years down in Southern California, and was actively involved in transitions and acquisitions with McKesson's ownership transfer team. And I own personally 3 pharmacies myself with other partners. And so we kind of live and breathe this stuff all day, every day. I have a home infusion pharmacy, a compounding non-sterile pharmacy, and then also a community retail pharmacy. So can provide some perspective from what I've seen in my years as an owner, as well as my experience as a loan officer. Since inception, we've done over 300 million in pharmacy loans. So a pretty big investment in community pharmacy. We are an executive partner for POLA, which is it's the Pharmacy Ownership Leadership Academy for pharmacy students. A lot of what we've heard from pharmacy students is they don't get a lot of training in the classroom on the business side of pharmacy, what it takes to be an owner, how to read financial statements, P&Ls, balance sheets. So POLA is an organization powered by NCPA that brings pharmacy students in for a week-long workshop and really educates them on what to do if they are thinking about community pharmacy ownership. It's really been a tremendously successful program. And because we are a community bank, and our model is to have a one-on-one experience with our applicants. So if you come to us, want to borrow money from us to accomplish your pharmacy ownership plans, we'll give you that same one-on-one attention that you give to your patients. So it's we want to match what you guys do there behind the counter and the service that you provide to your patients. We want to do that on the lending side as well.
Yeah, and if you work with either Bo or Drew, our two lenders, their phone number is the only one you need. There's no handoffs. Drew, for example, will stay with you all the way through the process of purchasing. There's not a handoff to loan operations and closers and underwriters and that type of thing. Drew would be your only person. And I know as a former owner, that's really important to have one number you can contact and get your answers, rather than a list of 10 or 12, like a lot of banks will put you through. We do offer a lot of different financing. Drew?
Yeah, so these are the things that we most typically will loan money for. Of course, acquisition of a pharmacy business and real estate. If a pharmacy owns the building, obviously we'll include that in the loan if you want to purchase the pharmacy building, or if you're leasing space and you see a building that you want to buy or construct, you want to do a ground up build, we would do that for pharmacists. If you have an expansion or remodeling project, when there was talks of USB 800 going on for pharmacies and new requirements are going to be met, there's a lot of expansion and remodeling talk. We also refinance existing debt and provide working capital. More times than not, if it's a working capital request, it's a good situation for the business because they're growing, or maybe they're getting into some specialty medications that might require some extra working capital, cash on hand, or if you have debt that you took on maybe from a wholesaler and you want to stretch that out over a 10-year term, that would be a typical refinance request or a local bank loan that you want to get better terms on. Those are things that we certainly can help with. Also, startups. There's not many banks out there that, and some of you guys may know this from experience, but if you've ever tried to go to a local bank or even a national bank and tried to get a startup pharmacy loan, more times than not, it's unfortunately a dead-end street. So we provide financing options for startup loans. And then our typical range, we don't really do anything less than $400,000. I know there's some equipment needs between automation that you may, have $150,000, pharmacy robotic equipment that you want to buy. That's not really our sweet spot. Our sweet spot is the $400,000 to $5 million type loan request, and that's where we really excel in some of our offerings.
And on the startups, we are very selective. They have to be a really, really well-written business plan, great marketing plan, and a complete understanding of what the business is going to require. So our startup loans, we are pretty picky with those, but we do startups. No question about that. I just want to talk a little bit This is NCPA data that we're looking at here. And there's we just want to talk about what do you learn from this kind of information. There's 22,000 outlets in the country today, independent outlets. That's been fairly stable. That may be decreasing just a hair, but not terribly decreasing at all. It's been fairly stable for many years, for several years now. But the churn within that year period is significant. And one of their estimates is that about 1,000 stores change hands every year. Well, what's this mean? Well, looking at the data, that means there's a lot of opportunities out there. So you have to keep your eyes open and be ready to move when an opportunity presents itself. Average revenue is about 3.6 million. I think we'll mention it probably a little later in the deck, but that's probably the bottom number of what you want to look at in trying to acquire a store. If you drop below about 3.6 to 4, and you get down in an area where it's really hard to develop a cash flow in today's world. Annual scripts are around 60,000. Gross profit is down. It's the lowest it's been in a decade at 22%. There again, what's that mean to you? That means you have to be very efficient. You have to turn a lot of prescriptions. I think what we always said when I owned stores was somebody said, how do you make any money? I said, we lose $1 on every prescription we make, and we fill and make it up in volume. But you have to turn a lot of prescriptions, but you also need other revenue streams. Drew mentioned his stores. They're not traditional dispensing stores necessarily. So other revenue streams is real important. And then a big one is the average number of stores per owner is up to 1.96, almost 2 stores per owner on average. This means there's a lot of multiple store owners out there now. Reason being, and I've looked at hundreds of business plans and financials over the years, the multi-store owners do tend to be and are more profitable than single store owners. The one thing that you will encounter there is as the pharmacist owner, you do have to shift when you start to get into multiple store situations from being a owner operator, being on the case most of the time and during the day, to being more of a CEO and running a business. Drew, you have any comments on this slide?
That's a good overview, and it's community pharmacy, we believe, is still very much alive and well. They've been holding steady at that 22,000 stores across the country, and there's a reason for that. It's because of the level of service that's provided. They're obviously, financially stable, and you can make a good living owning a store. And we're excited about the future of independent pharmacy.
That's perfect. And Drew, you're a living, breathing example of the vitality of this industry. I think y'all probably know the next couple slides what it says, but every survey, we did a lot of surveys at McKesson. There's been a number of consumer satisfaction surveys done. They all point to the fact that patients and customers prefer shopping with an independent and having their prescriptions filled with an independent. These are just a couple of the metrics that are looked at. Independents know their clientele. They know their patients. They know them by name when they walk in. They'll say, hello, Drew, how you doing today? They fill prescriptions much quicker than the chains, because quite frankly, the chains typically want you to shop. And no matter how busy the pharmacist is, they'll tell you it's going to be a half hour or 45 minutes, regardless of whether they're that busy or not. So I know when we had stores, if you had a lady come in with a baby who was crying and they just came from the pediatrician, you're going to bump them right to the front and get them out really quick. So this just goes to reinforce the fact that independents fare very well against chains. Another slide here is offering alternatives, lesser expensive drugs. Drew, in your practice, does that sound about right for you?
It does. It's super accurate. I mean, there's no other way to put it. The experience that you get at a large chain pharmacy does not even come close to comparing to the experience that you get from shopping at a locally owned community drugstore. So it makes us proud to be in this industry, and it makes us proud to work with individuals like yourselves that take care of patients the way you do.
Now we're going to get a little bit more into the nitty gritty of it. Where do you find an opportunity? And we have a bunch of them listed here. Drew, you probably work with a lot of people who've mentioned where they found them, and I imagine people come to you and asking, do you know if there's any stores for sale?
They do. They always want to know if we've heard of anybody that's looking to sell. But your best resources are going to be, we have wholesaler representatives as the first two. A lot of wholesalers have transition teams. They know of a lot. A lot of times they have lists of stores that potentially will change hands over the next couple of years. The local account reps certainly are they've been sidelined due to COVID for the last 12 months, but they're out and about now for the most part, and we'll know of opportunities that may come up. So drop your name as a potential buyer, and have them on the lookout for you, so they can be your eyes and ears as they're moving about their territories. But state associations is another one. I know there's several states that are very engaged with their members and reach out and ask pharmacy owners when they want to start working on their exit strategy. So they would be able to be a resource for you. And then don't be afraid to go visit local independent pharmacies and stop in and drop off a card or shake a hand. That's a great way to try to find stores that you potentially could buy one day. And then word of mouth relationships. You can't ever overdevelop your network. And so having a network in your industry of peers and people that you look up to, mentors, even competitors, you never know. You want to have a good relationship and be friendly with as many people as you can, because that's going to be to your benefit down the road. Bob, anything else come to mind as places to look?
Well, I just wanted to mention and reiterate one thing. As a former, as an aging former owner, I can't tell you how many times a month one of the chain acquisition guys would stop in and ask me if I wanted to sell the store. So dropping by and just visiting independents, taking a look at the store, kind of getting a feel for whether they might be up for sale at some point in time, and getting your name out is important. But keep in mind, when you drop that card off, these transitions are very confidential. The owner doesn't want his staff to know. He doesn't want competition to know. May not want the wholesaler to know that they're going to be selling. So don't expect, hey, I'm ready to go. Typically, that's going to be a phone call later in a private situation. So just keep in mind, these things are very confidential, but dropping that card off, getting around every once in a while can serve you quite well, actually. And also the wholesale transition teams. Of course, I'm a little bit biased towards RX ownership since I developed it, but all three major wholesalers have good transition teams, and it's good to connect with them. Let's see what we got next. Well, planning to buy or start. Drew, do you encourage buy or start? What's your bias there?
It's interesting. If you ask me the question, I say your ROI, there's less risk involved. All things point to an acquisition being the safer play, and that's the one we certainly do the most of, and the one I would recommend. That being said, I've started 3 from scratch, so you got consider that you can be successful starting your own, and we've done a bunch of them on the lending side, and then personally, we've successfully started three different types of stores over the last 8 years ourselves. But it's just got to be the right fit for you, and you don't. You want to look for stores to purchase. If your particular area doesn't have any stores to purchase, then look to start one, or maybe one sold out and you want to start one up back behind, that backfill type situation. Those are great startups. But I I would, look at both options because they can be viable as long as the business plan is solid. And it's not a well-written business plan. It's just, does it make sense, and is that market prepared to support a new business? That's the big thing when we talk about business plan. Is just, does this make sense, and can you see it being successful pretty clearly in your particular market? And then you want to develop a team as you, whichever route you go. You want to make sure you got a good attorney, a good CPA, a good wholesaler, a good bank, because all these things we're talking about today require money, and you want to make sure you have the right partners across the board. What else would you add, Bob?
Well, I just on the attorney, CPA, and bank, you really want a partner there who understands pharmacy. There's a lot of attorneys out there, and a lot of them do business type work, but same with CPAs. You really need an attorney and a CPA and a bank that understands you, understands your business, and can tailor their services for you. So that's real important. And there's a lot of them out there that specialize in pharmacy work. The other thing with purchasing, and that first one, Andrew touched on it, where you're willing to purchase, you might have to expand your horizons as to where the stores are available. They may not be walking distance to where you live. So you may have to expand your horizons a little bit when you're looking to purchase. Drew, you want to walk them through the timeline we got here?
Sure. Well, first and foremost, you want to make sure you have your credit in order. We are decently flexible on credit score for the most part. We're not seeing many pharmacists that have an issue with this, although there are, certain circumstances that would cause credit score to go down. But usually what we like to see 680 or better on the credit score.
Hold on, folks,
but more than that, we want to make sure that your personal financial statement is in order. You don't have a lot of credit card debt. You don't have student loans are okay, but it's the boat, the 3 cars, the motorhome, RV, all those things. You just want to make sure those are fine, but it also is an indication of how you manage money. So good credit in terms of score, but also good credit in terms of decision making when it comes to borrowing money from your local bank or lending institutions. Find the right pharmacy, find the right business plan. That's the biggest thing. More times than not, I would say 75% of our decision on whether or not we're going to do a deal or not comes from the pharmacy itself. So don't put too much pressure on yourself in terms of, I don't have this much net worth or this much cash in the bank, or, I'm still young in my career. We're okay with that. We believe in what you can do as a pharmacist, but we want to know that the pharmacy you're buying can support our loan, because it's not going to be you personally that pays us back. It's going to be the business that pays us back. Obviously, you want to have a valid pharmacist license or a business partner. Make sure that's in good order. We do check to make sure if there's any negative, marks on your pharmacist license over since you've been a licensed pharmacist. And then a passion and desire to own a business. That is certainly key. And a lot of times that comes through even over a phone call. All of our lending is done remotely as we lend in all 50 states and can't be there, face to face with everyone we do business with. But we want to make sure that you have that strong desire to be a pharmacy and business owner, because a business owner is what you are, and you got to understand the business and understanding the opportunity that is in front of you, doing your own due diligence personally, really diving in, really digging into the valuation, the business trends, asking the owners hard questions. More times than not, we see pharmacists relying solely on their team to provide the due diligence. And that's fine. We stress the importance of, surrounding yourself with a good team, but we also want you to really dive into the due diligence and ask questions and look at valuations. And don't let the banker or the CPA or the attorney be the one asking all the tough questions. We want you to be right there beside them, sort of uncovering any negatives or any potential pitfalls that an opportunity might have. Again, understanding financial and performance benchmarking, NCPA, Cardinal Health puts out the NCPA Digest. That's a great resource to compare the pharmacy that you're looking at versus industry standard or industry averages. And so use that, find that, get your hands on it, and it can really help prepare you to do a lot of good due diligence. You want to not skip any steps on negotiations. You want to be, you don't want to do anything without relying on your team to make sure everybody, agrees with your offer, agrees with your valuation models. And then you want to start with typically a term sheet or an LOI. LOI is a letter of intent. It's more or less just a written offer on paper that's non-binding between you and the seller that just sort of outlines timeline, purchase price, cash down, seller financing if there is any. That's where you want to start. And you want to make it contingent upon financing, of course. So you don't get into a situation where you've overextended yourself or overcommitted yourself without having the funds to actually make it happen. And on a startup, in particular, don't get ahead of yourself. Financing is key. It's hard to get financing for a startup. And so you want to make sure you pick out a location, you do your market analysis, you go to a bank and apply for financing, but don't sign a lease agreement. I was talking to somebody 3 weeks ago, and it turns out they had already signed a lease agreement and were committed for the next 12 months to paying rent each month on this space, and she didn't have any financing. And that's an error in judgment, in my opinion, where you're making a decision before you have the necessary backing to go execute a plan. So really consult, really be in tune with your advisors and let them help you along the way. In today's environment with SBA lending, you have to have cash available to create a down payment. And there's really no way around it. Every deal requires some sort of cash injection, cash down payment from you. So you got to be saving cash and preserving cash or have access to cash to make a deal happen. So be mindful of that. And then if you can find mentors in the industry, they're out there, they want to help. This is a close-knit and helpful profession where everybody wants to see others succeed, especially if you're not in the same market. Everybody's usually very courteous and offering advice and offering experiences and lessons that they've learned over the years. So find a good mentor, wherever that may be. That will definitely help you be more successful, especially if you're a first-time owner. Bob, anything to add there?
No, I missed a lot of what you said because I went dead there for a little while, but I'm back up. The only thing I don't know if you touched on is does student debt eliminate you from being able to get credit or get financing?
No, we talked about that, and student debt is okay. We talked about the manage your credit card debt, keep that in check. Also, the RVs, the auto, the 3 cars, and the tractor. Let's hold off on that. But student loans, perfectly fine.
Okay. And the other thing that I wanted to mention, and we'll probably mention it a number of times, is cash flow is king. And we're going to go into doing valuations now, which Drew will talk you through these valuations. But the fact is, when you do your business plan, what we're going to look at is cash flow. Does it support the loan? Does it support the business and support the loan at the same time? So Drew, you want to talk a little bit about what's valuation, what's it mean, and how do we do them?
Sure. Well, it means what a business is worth, or what somebody will pay somebody for that business. And there's a lot of different formulas out there, a lot of different ones that people use. There's the ones that chains use. There's ones that independent buyers use. And we're, of course, not chains. We're not chain lenders. We're not chain buyers. So we're going to look at the EBITDA or the earnings, the net profitability of the store, and use a multiple off that, usually 3.5. EBITDA stands for earnings before interest, taxes, depreciation, and amortization. And so you want to really uncover what the net income is, add back depreciation, amortization, interest, expense. Also find out if there's any add backs. You know, is there anybody on payroll that doesn't contribute to the business? Country club memberships, life insurance for the older owner that's pretty expensive that you're not going to have, auto expenses. All those things can be added back to that EBITDA number. And then we like to use a multiple off that, again, usually around 3, 3.5, and then you'll add the inventory number on top of that. That EBITDA number times 3, 3.5 is giving you your goodwill number or intangible asset value. And then you'll add the inventory on top of that. You also do want to look at prescription reports, profitability reports. Payer reports is a big one, and understanding payers and who pays well and who pays poorly in your particular market. Top 100 drug dispense is something we'll request and we'll look at. You know, how much of the payer population is cash, and could you lean more on cash? If DIR fees are significant, is there a way to run more claims via the cash plan that would help improve the profitability and reduce those DIR fees? You want to grab the 3 years of tax returns and then the most recent profit and loss statement and balance sheet. And it's good to look at, you know, basically you're going to try to look at 4 years, 3 years tax returns, and then the current year, and see how it's annualizing and trending. And that'll give you a good feel for what the business has done over the last couple of years and where it's going. Anything beyond 3-4 years is basically irrelevant at this point. We're just going to look at those 3 to 4 years.
And one thing when we're looking at the dispensing records is, you know, are you in a one doctor town? That's a big risk if there's only one prescriber in the town you're in, or are a huge number of your prescriptions made coming from one prescriber. That's a risk. So you do want to look at the dispensing. What a pharmacy is worth, I always say, you know, it's worth what anybody else is willing to pay for it. Is about the bottom line. On this slide, it's really just saying that it's a lot like buying or selling a house. You know, the realtors bring in comps, and that's what other houses have sold for around you, but doesn't necessarily mean that's what yours is worth. You want to talk a little bit about what the pharmacy must do here?
Yeah, you don't want to overpay for a store right now, really ever. But when margins are as tight as they are and reimbursements are what they are, you just really want to get that valuation correct. And it's all about cash flow. And we like a debt coverage ratio of 1.3 or better. So what that means is there's 30% more money coming in than going out. So you have a 30% cushion, basically. So if it was a 1-to-1, you know, you'd have exactly enough money coming in that the pharmacy was making to satisfy all of your requirements. We want to see that as a 30% cushion there, so you can experience, I guess, get you through the seasonality that pharmacies has, but also any ebbs and flows as you take over ownership, that you do have that cushion there of 1.3 or more. Obviously, the higher the better, because that's going to give you more cushion.
This is a busy slide, Drew, but maybe you could just hit a few of the highlights on identifying what's attractive and what's not attractive.
Yeah, you guys can read over this as I'm talking here, but most of this stuff is you feel like stating the obvious, but it needs to be said that when somebody comes to us and say they want to buy a pharmacy and they're doing 1.8 million in sales, it barely has enough to pay a pharmacist, you know, a reasonable salary of $110,000, much less it doesn't have any money to pay a loan on it. There's just not enough margin there. And so, as Bob alluded to earlier, it's all about, you know, with volume with independent pharmacy. You basically, it's going to be $10, $11 a script, $9, $10, $11, you know, profit per prescription. So the more prescriptions you fill, the busier you are, the more money you have to play with. So you want to find stores that have good profitability. Maybe they have a DME component. Maybe they have a compounding component, which drives up that gross profit margin. Expenses are not overwhelming, specifically rent. That's one that you really can't, I guess, reduce. If you can trim off staff, you can trim off, how much you use a relief pharmacist or maybe get a better deal on your insurance, but rent is what it is. So you got to make sure the business can support the overhead. And then what's the competition on an attractive store? Hopefully you're the only independent in town, or, there's only one other independent, and you may have the opportunity to buy that independent down the road. So what does that look like? The non-attractive stores, anything less than $2 million in total annual sales. I don't think those are, you can do that with cash, but to try to squeeze in a bank loan and borrow money to get in a low volume store, like I said, it's just hard for it to all work. And then, poor, unclear, outdated financials. That's one we see a lot. And even something to think about is if you own a store now, make sure you keep clear, accurate, timely financials, because that's when you come to sell your business, that's what a buyer is going to be looking at. So you want to make sure everything's organized, put together, and you have a good accountant that's working for you, for your business. Anything I missed that you thought is important, Bob? Bob, you there?
I'm back. Can you hear me now?
Good. I got you loud and clear.
Yeah, I disappeared there again for a second. So the only thing I would mention on this one is the lease terms. Did you mention the requirement for the lease?
Yeah, I didn't mention that specifically. That's a good point. We do want to. The SBA has a requirement that the lease has a term, or at least options to renew the term to cover whatever the SBA loan term is. So if it's a 10-year loan, you got a 5-year lease, they're going to want to see that you have an option included in your lease agreement to renew it for 5 more years to add up to 10 years. So if SBA wants you to be able to, and we do too, if you want to stay there, you should have the ability to stay there.
And now talking about valuation formulas, I've done a lot of research on valuation formulas, and I've seen studies done by PharmDs at some of the larger institutions that have identified 40 to 50 different valuation formulas. We've settled in on about 3. I'll talk about 2 of them, let Drew talk about the other. Percentage of annual gross sales plus inventory is what you would call, just your quick and dirty guess at what the value is. It's somewhat accurate. Now you can see the spread is 15 to 25%, but it's going to put you in the ballpark, give you an idea of what that store might be worth. The one on the far right is dollar multiple of annual prescription count plus inventory. This is the chain method. They'll take your total annual prescriptions, 60,000, multiply by $10 to $20 and add inventory, and that's what they'll offer. However, as a bank, we use the multiple of cash flow, and I think Drew, you mentioned that earlier. So you might walk through that quickly because I think you talked a little bit about that already.
Yeah, we have, but just that's obviously what the cash flow is, what's going to pay your monthly loan payment. So you want to make sure the business has enough money coming in to make that loan payment. So that's the one that really hones in on what a pharmacy business is worth to an independent buyer.
That multiple 2.5 to 4, what we typically range right around 3, don't we, Drew?
Right, 3, a little over 3, something like that.
Okay, you want to walk them through this example of what a valuation looks like?
Sure. Just to give you a quick example so you can kind of see, and you could, if you're ever looking to buy a store, you could certainly do this on your own. But this particular pharmacy has total revenue of $4 million. They do 65,000 annual prescriptions, and their normalized EBITDA. So this is a number that we went in there and added back their net income from the tax return of $145,000, depreciation and amortization of $60,000. The owner takes a above average or above market rate compensation of $50,000 that was added back. There's a personal $15,000 expense for I guess Lexus is what's listed there. I guess we'll call that the owner's automobile. And then the spouse of the owner also takes a $45,000 bookkeeping salary, which is not necessary. So we can add all that back and get to a normalized EBITDA of $315,000. So that's where that number comes from. And in this option 1 cash flow method, we're using a multiple of 3. So 315,000 multiplied times 3 equals 945,000 for goodwill. And then you're going to add inventory. Obviously, you can look on the business balance sheet to see what they estimate inventory to be. But more times than not, you're going to have a third-party inventory crew, Regis, somebody that comes in and counts the drugs on the shelf right before closing, and that's the number that's going to be added onto that goodwill number.
And then option two, I just quickly, option 2 and 3 you can look at. Those are the ones that we really don't look at too close, and you can see the numbers bounce all over the place. So option 1 is the one that we would really focus in on. And the other thing I'd mention is, Drew mentioned it before, your due diligence is important. Finding the fact that that $45,000 for the bookkeeper is critical, but you got to sometimes dig to find this stuff, and it depends also on how good their financial statements are.
Exactly.
Here's a sample purchase structure. Go ahead, Drew. You got this one.
Yeah, a lot of people ask, is it better to do an asset purchase or a stock purchase? For the buyer, you want to go with an asset purchase if you can. Unless you're in a state where it's difficult to transfer licenses and contracts and DEA permits, then you might want to you want to buy their entity. That would be a stock purchase or a membership interest purchase if it's an LLC. But for you, for tax purposes, an asset purchase will allow you to, and this is sort of a tax benefit, but you'll be able to re-amortize and re-depreciate all the assets that you're buying. So it'll give you less of a taxable net income down the road. So it'll save on some tax. And you don't have the liability that might pop up of buying someone else's company. You don't know what was done, years prior under that entity. With an asset purchase, you're going to set up your own company, a brand new company that you know the history of, and you don't have to worry what was done prior and potentially, assume any liability of that. We would loan roughly 90% of the purchase price. It's not exactly, but just to keep it simple. And then you would be required to bring around 10% of cash as a down payment. If you can't bring the full 10%, there is an option to have the owner finance half of that amount, so 5%, and you bring 5%, but at minimum, you have to bring 5% cash. So that's where, there is no buying a store or starting a store without some cash to put into it. The very minimum is 5%. So make sure you do have some cash on hand. And then, of course, we would lend working capital on top of the purchase price for the pharmacy, because you are going to need money to run and operate the business. And that's where a lot of banks get hung up, because pharmacies, drugs are expensive. Payments are reimbursements are slow from time to time, so you need cash in the bank to be able to float that revenue cycle timeline, and that's where we'll give you the needed funds to operate the business.
And just the 10% is 10% of the total project cost, so not just the cost of the purchase, but also any closing cost and working capital, and is all rolled into that. So here's an example of that, Drew, if you want to hit that.
Sure. So carrying that valuation forward, and I think we're assuming that store had around $250,000 of inventory, $945,000 of goodwill. We estimated, based on the monthly purchases of drugs and payroll and all the other general and administrative expenses, working capital needed to be $175,000 cash injected into the bank account, and then $30,000 in closing cost. So that equals a $1.4 million loan amount. So the buyer, the 10% number obviously would be 140,000. In this example, the buyer has that cash available, so they're not going to require the seller to carry a note, and so we have 0 for seller note. But I'd say 50% of the time we do ask, or we have to lean on the seller to carry a note to help us if a buyer only has 5% cash. So that is an option that we see a lot. And then the total loan amount would be 1.26 million based on that budget. So $1.4 million budget, you bring $140,000 as the buyer, and then we would loan 1.26 million.
These are just a few of the, and this again is a busy slide, and y'all can read it. We're running a little long on time here. So these are just some of the things that are required in the actual transition. The one thing I would mention, and Drew, you can jump in after and hit it a little heavier, is on the purchase agreement, the second one down, that is a binding document. And that one and the letter of intent, you really need to lean on your accountant and your lawyer to assist you in writing those documents, because they can be pretty tricky. And also, I always used my attorney to negotiate my leases. That took me out of the negotiation, and he was a lot harder-headed than I was. So he usually got me a better lease than I would have gotten myself. So, Drew?
Yeah, I mean, the most important document by far in the whole transition buying store is the purchase agreement. So you want to make sure you really have good help and good representation on that to make sure that you're not putting yourself in a situation where you're going to be vulnerable down the road, and you know clearly what you're buying, what you're not buying. And we've seen simple purchase agreements, 5 to 6 pages, and we've seen lengthy ones, 90 pages. I'd say somewhere in the middle is probably appropriate. But you just want to make sure that you have a strong understanding and good counsel when negotiating those final transaction pieces.
Yeah, and the other thing I would hit on this one is the employee transition strategy. I mean, there typically are going to be key employees, but there may be also employees that really the owner would have gotten rid of if he had his choice there. So you want to take a look at the employee transition strategy so you can keep the key ones, but make sure that you have a very highly performing staff when you finish. Here's some of the do's and don'ts, another pretty busy slide. So I'm going to hit one, and Drew, I'll let you hit the rest. And it's the one that I think is critical, and that's don't be emotional. This is a business decision. Don't fall in love with the store and forget all the business parameters that you have to look at. So don't be emotional. I know that a lot of you really are dying to get into a store. Make it a business decision. I think that's critical. Drew, you want to hit some of the others?
Yeah, that's a good word. On the do, expect the unexpected. Yeah, it's going to take longer than you think, and that's okay. And it's probably to your benefit that it takes a little bit longer, because a quick transition can a lot of times be harder on the staff and harder on your customers. So a lot of people start off with a call, how quickly can we close? Well, it takes time. It just takes time to transition a store, and you can't skip steps, and you don't need to skip steps. And so go into it with that mindset, and really don't get into a bidding war. Second to last point on the don't side, really need to buy at the correct price and the correct valuation, because you don't want to get in a spot where you overpaid something and you're just fighting it every single month to make ends meet, because that's not an enjoyable experience. I can tell you from deals I've seen in the past. But just like Bob said, don't be emotional. Make sure you do your due diligence and be patient with these transactions.
And one other thing I will mention is, because I see it all the time, and that's the owner is trying to sell you potential. what you need to do is see the potential, but not pay for it. If the owner didn't develop that potential, you can't pay for it. You're paying for what is there. You can't pay for what the current owner didn't develop. So you really want to see if there's potential, but be careful. Don't be tricked into paying for potential, because that's not on the balance sheet anywhere, is it, Drew?
It's not, Bob.
And so this is us. I apologize for the technical difficulties I had, but I'm sure Drew carried through my moments of silence there pretty well. Did we have any questions come up, Kelly?
We did not. We don't have any in the chat feature right now. I don't know if anyone has any they want to send through. I haven't seen any come through yet. I'll give them just a minute if anybody wants to send any, to give them a chance to answer any live. If not, you can also email them to myself, or also it looks like Bob and Drew's email is there on the screen as well. If there are any questions you have directly for them, and especially if you have any opportunities that you're looking at, you can feel free to reach out to them directly.
Yeah, we're always able to help, and as I said, I'm a consultant, and I don't mind really giving you some advice. But Drew, as you could tell, is an expert, and so if there's questions about financing, Drew is more than willing to talk you through it and let you know whether it's going to work or not. Drew?
I'm happy to help. I love to hear about opportunities, love to hear about possibilities that we can be involved and help you. So feel free to email, call, text, anything. We're here to be a resource for you.
And develop that. Yeah, go ahead.
This is Amr. How are you?
Hey, Amr. I think I remember a guy named Amr somewhere along the line. Drew,
Thank you. I really appreciate the presentation and being here on this webinar. It was nice talking to you guys. I have some guests here on the call that are interested more into startup pharmacy, and also like almost a newer pharmacy that needed more cash flow now that they had to go through the first year of pandemic situation. So what can you guys offer in that terms? Let's talk about like a second year pharmacy that's been open, that opened throughout the pandemic last year.
Yeah, I'll answer that, Amr. And you probably know this from past experience, but that's probably the most difficult loan request that we would get in trying to make something work, because it's just kind of in that in-between phase. It's not a startup where we can base the loan request on projections and how we see the business going the next first 3 years of operation. But it's also it's not a profitable existing business either, because it doesn't have positive cash flow yet, and it doesn't have the volume. And obviously coming out of the pandemic with all the unknowns about what your particular market looked like during COVID, and what your front end was like and what your traffic was like, it would be difficult. It would just have to be a one-on-one conversation each and every time, because there's no answer about what we could or couldn't do. I would just say in general, that's probably the more difficult area to be in, that 12 months to 24 months where you're not quite there yet, but you're getting there. If we can't see that the loan will be paid back for an existing business from a cash flow standpoint, it's difficult for us to do it. But that's not to say, it's a no across the board. We're also open to listening to each and every situation. And I think the other question you had was about startups. And yeah, certainly we'll look at each and every startup. Like Bob said, we'll be selective on them, and we won't do every single one of them. But the ones that make sense, that have a solid business plan, absolutely, we'll give those full look at.
Hey, Drew, also on the existing one that's a year in, or whatever, year and a half or 2 years in, what's their existing debt look like? Did they borrow money up front to get into it? So if there's existing debt, I think that would affect your decision making also, I believe, right?
It would. We want to know how much cash was put in by the owner and how much cash was borrowed, and what the other lender said about giving more money to the business, that type thing. So those are always more challenging, like I said, but certainly worth a phone call if you got a question.
Absolutely. Thanks, Amr. Any other questions from your group there?
Thank you, guys.
I haven't received any others through the chat feature.
Okay.
Let me ask one more question.
Actually-
guys.
Yeah, Amr, go ahead. Yeah, go ahead, Amr.
I'm kind of like bringing in. What about refinancing existing loans in terms of SBA loans, existing SBA loans?
Well, we'll both take
That's
a deep
something
breath.
that you guys do not
We'll
cover.
both take a deep breath, and then Drew will answer it.
Typically, those are not eligible, Amr. We used to do those each and every time if we could improve the payment by 10% or more. SBA allowed us to do those. Since then, about 2 years ago, they came back and said, if the business got an SBA loan, if it was on reasonable terms, then let's not do another SBA loan on similar terms. So, we would just look at the current SBA loans, and if those terms are deemed reasonable, i.e., it was on a 10-year, 120-month amortization, it had a reasonable interest rate, it was appropriately structured, then we probably won't be able to do it. If for some reason the small business did not get terms that were reasonable, then we could look at it.
And reasonable is a subjective word, I think. So I think it's really a difficult challenge for us now to get any refis of SBA loans done. Now, Drew mentioned an opportunity for refis, and that's of wholesale loans. Yeah. So if the wholesaler has loaned you money and you want to extend that out 10 years, and I think you see those pop up every once in a while, don't you, Drew?
We do. Yeah. There's one that, and a lot of times wholesalers they'll structure things a little different than we would. The interest rates will be higher, 8 or 9% typically, and they may be on a 7-year term and maybe have a 5-year balloon. So any loan, any debt that has a balloon is automatically eligible, and we can refinance those. And even loans that are on a 7-year term that would have been more appropriate for a 10-year term, we can probably refinance those as well. And any lines of credit that you may have, lines of credit are automatically eligible. I see a question that popped up about solid business plan. I'll just speak a little bit more to that to try to provide some clarity. But it's not so much as in a well-written or well-organized or has a good-looking, pretty logo. That's not necessarily what we mean by solid business plan, although that is an indication of how you do your work. What we want to see is that there's a compelling reason. In particular, when I'm talking about business plan, we're probably talking about startups. Why are people going to shop with you as opposed to the pharmacies that are already there? And it's maybe because you are the main pharmacist in that town at a busy store at a chain, and you're going to walk across the street and start one because you don't have a non-compete, and you're going to bring a lot of those patients with you. That's a solid business plan. We can see that, we can feel it, we can, make projections off that. Or if, like I said, a pharmacy that closed or sold out, you want to start one back up behind it, we can certainly do that. Or if there's just no independent there, there's a lot of different ways you could say solid business plan, but it's just, is there a tangible, we can wrap our arms around sort of your strategy and it makes sense? That's, in my view, what constitutes as a solid business plan. Bob, anything to add there?
No, and that was a great answer, by the way, Drew. No, and I think, Kelly, we're about ready out of time here, aren't we?
We are. I don't know if we have time for one more question because one just came through.
I do.
It says, Kelly, what is the average interest percentage for the loan?
What are we running right now, Drew? Prime plus?
Prime plus 175, which is 5%. So 5% is our current rate.
Okay.
Is that negotiable, Drew?
It's kind of what the market is right now.
Yeah.
And we try to be underneath our competition. So I would say that's about as good as there is out there. And then of course everything is worth a discussion. So
Yeah, and most of the loans that rates that I've shopped around and seen tend to be a little bit higher, 5.5%, even 6%. So I think that's a pretty fair rate you just quoted there, Drew. Kelly, thank you. I'm sorry for the technical difficulties I had. I hope that didn't upset us too badly here. Looks like we're finished up pretty close with the time. If anybody has any more questions, feel free to email them in, get hold of us. We're always available to talk to you. So once again, thank you for having us. And Drew, thank you for being on.
Yeah, enjoyed it. Thanks guys. Thanks for having us, Kelly.
Thank you both. We appreciate you putting this together and doing this for our membership, and we appreciate the longstanding partnership. We greatly enjoy working with you and assisting our members, and we hope that everyone watching this call, if there's anything that you're interested in, that you reach out to someone on the team, because First Financial is here to help, and they've assisted our members through the years. I think the relationship was well before I joined the team, but it's been a long-standing relationship, and we really value it and appreciate everything you do to assist our membership in their financing needs. So thank you for today, and any questions we receive, I'll forward over to you and your team.
Perfect. Thank you very much.
Thank you. Have a great day.
Appreciate it.
You too.